Why are some mortgage rates going up when interest rates are coming down? It's a good question. Stick with me until the end of the video and I'll tell you what's been happening and why some mortgage rates are going up even whilst the Bank of England is cutting base rate. Before we look at why some mortgage rates are still going up, let's rewind a bit and look at what's happened with buy-to-let rates over the summer. Short version. Rates have drifted down, mortgage product choice has exploded, and higher LTVs are creeping back. It's not yet a rate war, more of a gentle thaw, but at least things finally seem to be heading in the right direction. Right now, 2-year fixes are averaging about 4.88%, 5-year fixes around 5.21%, and there are over 4,600 buy-to-let mortgage products to choose from. That's an amazing number, the most we've seen in 3 years. 6 weeks ago, rates were just a touch higher, so the moves look tiny on paper, but on bigger balances they do add up. A few lenders led the charge. The mortgage works went early, trimming deals in July and again in August. Precise cut more aggressively mid-August, even bringing back 80% LTV, something we haven't seen much of lately. Paragon joined in too, keeping higher LTVs on the menu and slightly softer stress testing than a year ago. So things are a little more encouraging. The Bank of England helped by nudging base rate down to 4% in August. True, that doesn't directly set fixed rates, but it makes lenders braver about inching down. But here's the bit that confuses some people. If Bank of England base rate is falling, why did some lenders actually raise their mortgage rates in September? Only by 0.1 or 0.2%, but still it feels backwards and somehow not right. Or is it just me who thinks that? There are 3 boring but important reasons which explain this. Here's my layman's very non-technical explanation. First, swaps and gilts rates, the amount it costs the government to borrow, spiked after the base rate cut. That led to higher rates on the international money markets where banks borrow. So even with lower base rate, the funding curve went higher. That mismatch forced some lenders to push rates up. Second, volatility makes lenders nervous. If swaps are bouncing around, treasury teams pad the margins. Better safe than sorry. In other words, they put rates up just in case. And third, sheer volume. When cuts bring in too much business at once, lenders lift rates to slow things down and protect their service levels. None of this points to a big uptrend, not yet anyway. It's more like a noisy plateau, maybe with a slight downward slope, until the next inflation wobble puts a spanner in the works. One thing to watch, fees. A lot of the eye-catching rates come with chunky product fees. A fee of 3% is pretty common right now. Sometimes that works if you've got a smaller loan, but on bigger balances it can actually cost more, even with a lower rate option. Always run the figures both ways. Assume that no one, least of all your lender, is doing you a favour. By the way, this is another reason why you should use a proper qualified mortgage broker. In fact, most lenders won't deal with you direct anyway, and insist you go through an intermediary. If you'd like me to put you in touch with my very good mortgage broker, please stay to the end for details. So what does all this mean if you're investing? If you failed affordability back in the spring, it'd be worth running your numbers again. More products and softer stress tests on some 5-year fixes could make the difference now, especially if you're buying in higher yielding areas. Choosing between 2-year and 5-year deals is a real toss-up. 2s are cheaper, but you face refinance risks sooner. 5s gives you stability, and the stress testing is usually gentler. There's no universal right choice, but it's important to pick the product that fits your plan. Again, talk this through with your mortgage broker. And yes, 80% LTV is back in play, which helps purchases stack up, but always read the fine print. Those free cashback deals can vanish if you hesitate. So, bottom line, the last couple of months have been the best we've seen in a while. Rates edged down, choices at a 3-year high, and higher LTV options are back on the shelf. It's not 2015, and it won't feel like it, but deals that didn't work in July might just scrape through now, assuming the rent stacks up and the fees don't wreck your numbers. And this is why you need to be talking to your mortgage broker. And as I said right at the beginning, if you don't have a mortgage broker, and you will need one because most, if not all of these lenders will only deal with an intermediary and won't deal with you direct, then I recommend my very good mortgage broker. So if you have any questions or need any assistance around buying a property with a buy-to-let mortgage or refinancing, or if you are coming to the end of a fixed rate, you're not sure what to do or which product's going to be best for you, then please do drop me an email, thepropertyteacher@gmail.com, thepropertyteacher@gmail.com, and I'll be very happy to put you in touch with my very good mortgage broker. And by the way, not just for buy-to-let products, if you have any need for assistance with any type of property finance, whether that be bridging or development, as well as buy-to-let, then please do drop me an email and I'll put you in touch.